This video is the second in a 10-part series designed to look at every aspect of Unit 3, the Diploma in Financial Studies. Topic 2 is all about how the state can help. So in this topic we're going to look at what is state or government support, how the state helps people financially, the benefits which are replaced by universal credit, as well as sources of financial advice. So what is state support? Well, it's provided by the government in the form of a payment, loan or service to either effectively increase a person's income, so they purchase the service from the state instead of the private sector, which is funded by general taxation, or to prevent a person from entering poverty. That said, definitions are contentious of what poverty actually is, when faced with particular circumstances such as job loss, illness, or disability. So how does the state actually help people financially? The first way that they can help people financially is through job seekers allowance. Now, aside from universal credit, the main benefit for those of people who are of working age, who are not working full time, but who are able to work, is the new style job seekers allowance. To be eligible for it, you must have worked as an employee and paid Class 1 national insurance contributions, usually in the last 2 to 3 years. You must also be aged between 18 and retirement age, as well as a number of different criteria. After 182 days, which is around 6 months, you'll have to talk to your work coach about your options. The second way that the state helps people financially is with statutory sick pay. If you're employed, your employer has to pay you at least statutory sick pay if you have been off sick for 4 or more days. The benefit is a fixed weekly amount that is paid for a maximum of 28 weeks. If you are self-employed or not working at all, you cannot claim statutory sick pay. The third is through Employment and Support Allowance, ESA for short. This helps people who are disabled or ill and cannot work, or supports people to get back into work if they are able. To be eligible for ESA, you must be below the state pension age and have worked as an employee or been self-employed, as well as paid enough national insurance contributions, once again, usually in the last 2 to 3 years. A fourth way that the government helps people financially is through housing benefit. Now, this benefit is to help people who are unemployed on a low income or who are already claiming benefits to pay their rent. It's been or has been replaced by universal credit, so you can only make a new claim for housing benefit if you are single and have reached state pension age. If both people in a couple have reached state pension age, if one person in a couple has reached state pension age and started claiming housing benefit before the 15th of May 2019, or you are in supported, sheltered or temporary housing. The fifth way that the government helps people financially is through support for mortgage interest, or SMI. Someone making a claim for certain qualifying benefits and who needs help with interest payments on their mortgage or loans taken out to make certain repairs and improvements to their home may also be able to claim SMI. The benefit will cover only the interest due on the mortgage, calculated as a standard rate, and not any capital repayment. The sixth method that the government helps people financially is through income support. This has of course been replaced by universal credit, and it's an older benefit that's been replaced now by universal credit. It was paid if you could not be available for full-time work and did not have enough money on which to live. People could work up to 16 hours a week and still claim income support, but would not get anything if they had savings of more than £16,000. The state pension is also another way that the government helps people financially. It's a non-means tested, i.e. not income related, contributory benefit paid to everyone who has reached state pension age and who has paid for or has been credited with sufficient national insurance contributions. People who reach state retirement on or after the 6th of April 2016 receive the new state pension. This scheme requires people to have 10 qualifying years of national insurance contributions or credits to get any state pension, and 35 qualifying years to get the full new state pension. Working tax credit is another way that the government helps people who require financial support. Working tax credit is closed to new applicants unless they are already claiming child tax credit. Child tax credit is closed to new applicants unless they are already claiming working tax credit. Individuals who are not eligible for working tax credit or child tax credit can apply for universal credit instead. The credits provide an additional income designed to top up wages to an amount that ensures that claimants are better off working than being unemployed and claiming other benefits. Now, statutory maternity pay and statutory paternity pay, SMP and SPP for short, are another way that the government helps people financially. SMP works in a similar way to SSP. If a woman is employed full-time or part-time, her employer must pay statutory maternity pay, up to 90% of her average weekly earnings for the first 6 weeks, for up to 39 weeks, so that she can take maternity leave to look after the baby. Eligible fathers are also entitled to SPP, but this is paid for only 1 or 2 weeks, unless the mother and father choose to use shared parental leave and pay. Eligible parents who must have been working for their employer for a certain length of time can share up to 50 weeks of leave and 37 weeks of pay between them. The Social Fund, or crisis loans, otherwise known as Community Care Grant, are another way that the government help people financially. From the late 1980s until 2013, a government-funded social fund provides additional grants and interest-free loans to claimants in exceptional circumstances. These were available as one-off assistance in emergency situations. Personal independence payments, or PIPs, are another way that governments help people financially. The benefit replaced Disability Living Allowance from April 2013 for those aged 16 to 64. Fewer people are eligible to receive PIP than were able to claim Disability Living Allowance. The rate paid depends on how a claimant's condition affects them, not on the condition itself. The final way that the government now helps people financially is through universal credit. The biggest change to the benefits system was the introduction of this benefit in 2013. It was initially on a trial basis in selected areas, but has now been launched nationwide. The stated purpose is to simplify the benefit system by replacing 6 existing benefits with a single monthly payment for those living on a low income, whether they are employed or not. The 6 benefits which were replaced by universal credit are firstly income-based job seekers allowance, income-related ESA, income support, housing benefit, child tax credit, and working tax credit. Following repeated delays, the delivery of the universal credit full service to all job centres in Great Britain was completed in 2018. The government expects all households claiming legacy benefits, i.e. the benefits that are being replaced, to have moved across to universal credit in the next few years. So where can we go for sources of financial advice? Well, we can go to Money Helper. In the wake of the 2008 financial crisis, politicians from all parties agreed that there was an urgent need to improve the general public's knowledge and understanding of personal finance, and it was felt that when it came to handling their finances and making the best use of appropriate financial products, too many people were financially illiterate. The Financial Services Act of 2010 introduced measures designed to improve financial literacy. Citizens' advice is another source of financial advice. Government part funds two national debt and money advice charities. Citizens' advice is one of these. It was set up in 1939, a few days after the outbreak of the Second World War, and today comprises a registered national charity, Citizens' Advice, which can be found online and at more than 250 Citizens' Advice offices, each of which is an individual charity at local level and which offers face-to-face assistance in more than 2,500 community locations. Citizens' Advice, in fact, regularly helps over 2 million people each year by phone, face-to-face, by email, and through its website. The Money Advice Trust, or MAT for short, is the second money advice charity that the government part funds. Since 2000, the Trust has been responsible for operating the National Debt Line, which is an online and telephone advice service that helps people to sort out their debt problems. Local council debt counselling services are another source of financial advice. It's not only the national government that funds money and debt advice services, many local authorities also provide their own local services. Step Change, the debt charity, is a national charity offering free debt advice. It started life as the Consumer Credit Counselling Service in 1993, but changed its name to Step Change Debt Charity in 2012. Now, unlike the Citizens' Advice and the MAT, Step Change does not receive any government funding and relies instead on contributions from banks and building societies. It offers a personal debt advice and debt management service, both online and by telephone. PayPlan is a free online debt management service that operates in a similar way to National Debtline and Step Change. Whilst it's not a charity, rather than charging clients a fee for managing their debts, it actually receives donations from all of the lenders with which it arranges debt management plans. You may also get advice from banks and building societies. There's actually a link here to corporate social responsibility, which we'll cover later on in more depth. Now, banks and building societies, some would say, have a duty of care to look after their customers and therefore are very keen to offer advice for their individual consumers. It's also something that they can say they are doing in order to fulfill a corporate social responsibility policy, thereby giving them a positive reputation. So, that's Unit 3 Topic 2 in a nutshell. Make sure you like the video and hit that subscribe button. I'll leave a link to Topic 3 just at the top of the screen. Before you go though, let's check your knowledge. The first question: some benefits are paid to people who are working full-time, but this will depend on their level of income. These benefits are flat rate, income tested, or means tested. The answer to question 1 is D. Income-related benefits are means tested. Question 2. If a woman's employed, her employer must make statutory maternity pay for up to how many weeks so that she can take maternity leave? Is it 13, 26, 39 or 52 weeks? The answer is C. If a woman's employed, her employer must pay statutory maternity pay for up to 39 weeks so that she can take maternity leave to look after the baby. And question 3. Which of the following is a state benefit, replacing 6 benefits with a single monthly payment for those on a low income? Is it family credit, income support, job seekers allowance, or universal credit? Before I give you the answer, make sure you subscribe for the next video, and I'll also leave a link to multiple choice question preparation. So the answer to question 3 is D. Universal credit is a new state benefit that replaced the 6 existing benefits with a single monthly payment for those living on a low income.